Meanwhile, Rio Tinto says it continues to see a strong performance across all of its operations despite market volatility due to uncertainty over China's economic health. Our next guest, though, believes China's downturn represents the beginning of a new normal that corporates just have to adjust to. Dr. Wang Qing is Managing Director, Deputy Head of Investment Banking Department at China International Capital Corporation. Very nice to see you today, sir. Well, look, this new normal you're talking about doesn't seem much different, if you believe the official data, from the old normal, i.e. the export figures, the inflation figures, and indeed the broader GDP figures all seemed a little bit too good. Are they to be believed?
Well, if today's data compared to those data, say 2 years or 3 years ago, it's already a much difference, right? China's economic growth already slowed to below 8%, and China registered single-digit export growth for many years, first time in many years. So I think the new normal of Chinese economy will feature slower growth, higher inflation, and profound change of economic structure away from investment-driven growth to consumption-driven growth.
Yeah, and herein lies the problem. As long as we've been talking about China, we've been talking about the switch from dependency on the export picture to actually having a more balanced economy with a more vibrant domestic economy. But according to your nose, actually draconian housing policy rules actually are denting the growth in that domestic market.
Indeed, I think there's too much emphasis on the slower external demand and its impact on Chinese economy. What's less being appreciated is, in fact, is the domestic policy, especially domestic housing policy, and its negative impact on China's investment growth. Chinese government imposed draconian housing policy to try to deflate housing prices since second half of last year. And this policy measure really lead to massive slowdown in China's investment growth and industrial production. And I think this is the single most important factor in explaining China's slowdown and the weak demand for commodities from China.
Looking at this big picture, we'd agree entirely with your assessment there. But we are going through a political inflection point in China at the moment. Wen Xiaobo, a couple of years ago now, said that the shift from an export-led growth model to a more domestically led growth model would take about a decade. So what I'm going to ask you is, what sort of timeline do you put on the definitive arrival of your new normal, which clearly we are moving slowly towards? But we have above consensus growth numbers for China for the next 2 quarters. We're looking at 8.7 annualized this quarter, something similar next quarter, but the slowdown coming after the handover of power is completed in March, probably to somewhere in the 7 to 8 range.
Well, I think we are already in the new normal, because the average GDP growth between 2000 and 2010 in China was over 10%. Yeah. And the average inflation rate was only about 2 to 3%. But if you recall, in some quarters in 2007, China's GDP growth was as high as 13 to 14%. But in the recent quarter this year, China's GDP growth only like 7.5%. So we already witnessed a massive slowdown in Chinese economy. And so in that sense, I think changing already taking place.
I want to know what the new normal is for the iron ore price, because today we had comments from Fortescue, one of the major iron ore producers, and they're saying you expect to see the price stabilize around the 120 US mark. And this is higher than what we've got currently on market. We're about 114, but it is a lot lower than where we were previously, up around 190. So has Fortescue got it right that this could be the number where we start to see prices just flatline, or do you think that they're still way too optimistic given what you're seeing in China?
Obviously, there was a massive slowdown in China's steel production, and this has to do with, again, China's housing sector, because the housing investment slowed massively and lead to weak demand for steel. But since then, Chinese government start to stimulate the economy again without changing China's housing policy by boosting spending on infrastructure. I think that the recent stabilization of iron ore prices may have to do with the expectation that Chinese demand for steel may stabilize, and going forward we may see slow recovery.
Is there a honeymoon window to invest around the leadership transition? Because for face purposes, the Chinese government will not allow the Shanghai Composite to dip below 2,000?
Well, in fact, at some point, the Shanghai Composite Index already dipped below 2,000, and for a very short period of time. A very short period of time. But I think the weakness of Chinese stock performance has to do several factors. Weak economy, both domestic and external. Of course, the political transition and the uncertainty around political transition also weigh on the investor sentiment. And going forward, as the political transition is complete, say in November or as late as early March next year, I think overall sentiment should improve.
Very nice little book from our friends at Independent Strategy makes the case that the transition of economies from command structures to an evolved middle class that then leads consumer-led growth involves political transition as well. And the only way you get the right alignment of interests and incentives is to remove quotas and diktats, and that means democratic openness. Is China actually going to make that transition without reforming its political system?
Well, I think there's an overemphasis on policy and the system on the impact of economic structure or evolution of economic structure. In fact, what's going on in Chinese economy, especially with the what I call new normal, has to do with the labor market. China running out of surplus cheap labor. As the bargaining power of labor increases, the labor income will increase and squeeze the profit margin, discourage investment, and as people's income increase, they naturally will consume more. I think this has to do fundamental economic forces.
Thanks for your time this morning. Good talking with you. Dr. Wang Qing, Managing Director and Deputy Head of Investment Banking Department at China International Capital Corporation.